Welcome to Law Easy. My name is Marty Shenkman. I'm joined by insurance consultant and guru, Richard Harris, and we're going to talk about a topic that's quite important for some people in doing sophisticated insurance planning, premium financing. Richard, why don't you first define and explain quickly what premium financing is and some of the circumstances where somebody might consider it.
Premium financing is where somebody wants to buy a life insurance policy, but they don't want to pay for it, and they want to use other people's money, so they go to a commercial lender to borrow money to pay for the insurance policy.
So it could be something as simple as you have, you're a real estate developer, you have a family business, all your funds and cash flow are tied up in developing and growing the business, but you want insurance for long-term liquidity, succession planning. There are a whole range of other very vital reasons to your plan. Premium financing may be an option.
It may be.
What are some of the pros, cons, and then after that let's go through some of the considerations.
Well, unfortunately, premium financing is being sold as an end in of itself. It's being sold to people in amounts where they don't necessarily even need that amount of insurance. So people are convincing people to buy large amounts of insurance because they can do it with other people's money. And they're showing them illustrations.
OPM.
They're showing them illustrations that make it look like if it isn't a free lunch, it's a very cheap one.
Till rates go up.
Until a lot of things happen.
We should talk about that.
Yes. And so the first situation is you're buying insurance, and in the amount you're buying is because that's the amount that you want to have, and not because you can get it using other people's money. So we start out with that one.
Yeah, it's got to make sense.
Right.
Totally agree.
Right.
What are some of the issues? The one I mentioned is one that just comes to mind right away, that I've seen some of these projections, and they assume a current interest rate, which, people projecting interest rates were going to go up for a long time. They've kind of finally started going up a little. Now they seem to almost be coming down. But that is a big risk. How do you deal with that risk? And I know that some people have been suggesting that they have premium financing arrangements where they can guarantee, I always get nervous when I hear that word, guarantee that the rate won't increase beyond some certain amount.
Well, the answer is they never quite explain what that means.
Enlighten us, O Guru.
There's something in the marketplace called an interest rate swap. An interest rate swap is where you're paying somebody to guarantee you a certain level of interest higher than what you're paying now because they're taking the risk in exchange for them taking the risk on the fluctuations of the interest that you're paying, because these interest rates normally on a premium finance, they renew every year, and it's a different rate every year. So you're locking in a rate. But what people aren't explained is that it may cost 100 or 150 basis points more than your current interest rate to lock in a rate. So if you're at 3.5%, you may go to 5% and have a locked-in rate. And even there, your interest rate swap is only going to be for 10 years.
So that you got to be careful.
Yeah.
And you're paying for it, so you got to figure that into the whole analysis of what you're doing as well. It
Right.
may not be worth it.
Right.
Sounds good.
Yes. And I know as a consultant, I've been referred to clients who have been presented with premium financing propositions, and they have asked me to go over them and help them to understand what it is they are looking at.
Other than interest rate risk, what are some, and I guess we have two things, kind of being convinced to buy more than you need just because it looks good. Two is interest rate risk. What are some of the other risks or issues with premium financing that people should consider before they pursue it?
Policy performance, and along with policy performance comes collateral. The people that lend money on these types of arrangements put themselves in a position where they can never lose. You're paying the interest up front. You're putting up 100% collateral. So
the policy.
Not just the policy, you're putting up additional collateral over and above the policy.
Like?
Bonds, stock portfolios, things of that nature. so that the lender knows that no matter what happens, they're going to get paid. And I've seen people say, well, the lender wouldn't do it if it didn't make sense. They don't say make sense to who. In this case, make sense to the lender, not to you as the buyer. And these loans are normally renewable every 5 years. In the interim, you may have to produce a financial statement every year, and if they don't like it, even though they said they were going to loan you money that year, they're not obligated to do that. Plus, at the end of 5 years, that loan renews. You've now got to go out and negotiate a new loan under new terms.
So you really have to evaluate and understand the financial risk you're getting into.
Right.
Which also goes back to why you're doing this in the first place. So you have to have a good reason sufficient that it makes sense with the risks involved. Give some positive examples of where and how this makes some sense.
Well, you mentioned real estate. And it makes sense for real estate people because they understand interest rate risk.
Leverage.
And they understand leverage. And they understand collateral. So, one, it has to be somebody that's sophisticated financially that understands that. The other thing is these are often done in conjunction with IUL, indexed universal life policies, and you have to look at those projections because those projections may be unrealistic.
But that's tied to market performance.
Right.
Which means if the market goes down and the interest rates go up, you could get whipsawed.
Yes, exactly. And
that's...
and it's presented in exactly the opposite light, though, hey, interest rates go up, this is going to go up also. No.
Maybe I misunderstood, but the tone of a lot of your comments are cautionary.
Yes.
Do you not favor ever using premium financing? I mean, it certainly seems to make sense in a lot of transactions, but certainly not all.
It makes sense with people that are financially sophisticated, where they are explained and understand all of the risks, both in the policy they're buying and in the funding and the fact that they're renewing it, and they have an exit strategy in mind where they're going to get out of it. And the exit strategy isn't having the thing keep financed until they die.
That's a good point. To wrap up, Marty Shenkman, joined by Richard Harris. We were discussing premium financing. This is one of a whole batch of video clips on insurance planning. Please be mindful that this is for educational purposes only. Consult with your advisors before taking any action. Thank you.